a tightening market, demand for specialty intermediaries, the opening quarter of 2025 has unfolded under a cloud of economic uncertainty. With tariffs reintroduced on key imports, elevated inflation refusing to abate, and signs of declining GDP growth, the conversation among investors has turned to stagflation, a mix of stagnation and rising prices. The U.S. stock market reflected this anxiety, with the S&P 500 closing Q1 down nearly 5%. However, in the specialty insurance intermediary mergers and acquisitions market, a trend of strong buyer demand continues despite a shrinking pool of sellers. This supply-demand gap has intensified due to larger macroeconomic shifts. The specialty insurance market remains attractive to investors, driven by structural forces like consolidation and long-term growth in delegated authority models. Notably, in 2023, the sector witnessed an all-time high of 181 specialty intermediary transactions. However, the following year saw a decline to 120 deals, a 33% drop, revealing a growing scarcity of available sellers with vital underwriting expertise and scalable technology platforms. The specialty distribution landscape has transformed radically over the past 15 years. In 2009, fewer than 5 firms exceeded $1 billion in property and casualty premiums. By 2024, at least 28 firms had crossed this threshold, driven largely by acquisitions, with the top 10 now placing 2/3 of total specialty premiums. As of March 31, 2025, 19 specialty distributor M&A transactions had been announced, matching Q1 2024's total. However, the competitive landscape remains fierce, especially as private equity-backed firms accounted for a substantial portion of these deals, indicating pressure to secure high-quality opportunities swiftly. At Doxa, we see specialty M&A entering a more selective, strategic phase. Thinking about expansion, consolidation, or exit? Let's talk.